Hi everyone. In our last video, we talked about how investors record the purchase of a bond at a discount and how we use the effective interest method to prepare a bond discount amortization schedule and write the journal entry to record periodic receipt of interest revenue. In this video, we'll talk about 3 classifications of debt investments and discuss debt investments that are classified as held to maturity. But before we move on, let's do a concept check problem. Chan Inc. purchased bonds for $800,000 that have a maturity value of $900,000. That means the par value of the bonds that Chan purchased is $900,000. Please pause this video and write the journal entry that Chan would use to record the purchase of this bond and then select the correct multiple choice answer. When you finish, please start the video again to check your work. The journal entry Chan would write to record the investment is debit bond investment, $900,000 for the par value of the bond. Credit cash, $800,000 for the cash spent. And credit the contra asset account discount on bond investment for the $100,000 difference. How'd you do? Did you get it right? Illustration 12.3 in your textbook is an excellent summary on the classifications of debt investments. You should flag this page for future reference. The fair value of bonds will change as the prevailing market rates of interest fluctuate. Accounting for changes in fair value depends on the classification of the debt investment. As shown here, debt investments are classified in one of 3 categories: held to maturity, HTM securities, trading securities, TS, and available for sale securities, AFS. Why treat holding gains and losses differently depending on the type of investment? As you know, the primary purpose of accounting is to provide information useful for making decisions. What's most relevant for that purpose is not necessarily the same for each investment a company might make. For example, a company might invest in corporate bonds to provide a steady return until the bonds mature, in which case day-to-day changes in fair value may not be viewed as very relevant, so the held-to-maturity approach is preferable. On the other hand, a company might invest in the same bonds because it plans to sell them at a profit in the near future, in which case day-to-day changes in fair value could be viewed as very relevant, and the trading security or available for sale approach is preferable. The key difference among the reporting approaches is how we account for unrealized holding gains and losses. Unrealized holding gains and losses are less important if the investor will not sell the investment before its maturity date. So if an investor has the positive intent and ability to hold the security to maturity, the investment should be classified as held to maturity, HTM. Debt securities cannot be classified as held to maturity if the investor might sell them before the maturity date in response to changes in market prices or interest rates, or to meet the investor's liquidity needs or other similar factors. If an investment is classified as held to maturity, unrealized holding gains and losses are ignored, and the investment is reported at the amortized cost on the balance sheet. Remember that amortized cost is the face value of the security less the unamortized discount or plus the unamortized premium. Let's say that in a check of the market prices listed in the Wall Street Journal, we can see that the fair value of Masterware bonds on December 31st, 2021 is $714,943. As shown in the prior illustration, United's amortized cost of those same bonds is $671,297. December 31st, 2021, United's amortized cost of the bonds are $671,297. The market value of $714,943 less the unamortized cost of $671,297 equals an unrealized gain of $43,646. How will United account for this increase in the fair value of its debt investment? If United views the bonds as held-to-maturity investments, the change in fair value will be ignored. The investment simply will be shown on the balance sheet at the amortized cost of $671,297. United will disclose the fair value of its held-to-maturity investments in a note to the financial statements, but will not recognize any fair value changes in the income statement, the statement of comprehensive income, or on the balance sheet. Typically, held-to-maturity investments are held until their maturity date. However, suppose that due to unforeseen circumstances, United decided to sell its debt investment in Masterware bonds for $725,000 on January 5th, 2022. United would record this sale just like any other sale of assets, with a realized gain or loss determined by comparing the cash received with the asset's carrying value. A bond's carrying value is the same thing as its amortized cost. That's the bond's face value minus any unamortized discount, or plus any unamortized premium. Debit cash for the $725,000 received. Then remove the assets from the books by crediting investment on bonds for the $700,000 par value and debiting discount on bond investment by $28,703. Let me show you where that debit amount comes from. As you can see from the amortization schedule, the unamortized discount at December 31st, 2021, just a few days before the sale, was $28,703. The unamortized discount account has a credit balance, so to get it off the books, we need to debit the account by $28,703. Finally, we need to credit gain on sale of investments for $53,703. This gain is calculated as follows. Investment in bonds of $700,000 minus $28,703 unamortized discount equals a carrying value of $671,297. Sales proceeds of $725,000 minus the $671,297 of carrying value equals a gain of $53,703. There's one important exception to the general rule that companies don't recognize unrealized gains and losses for held-to-maturity investments. You learned in Chapter 7 that companies are required to use the Current Expected Credit Loss (CECL) model to account for bad debts with respect to accounts receivable and notes receivable. Companies likewise are required to use the CECL model to account for credit losses on held-to-maturity investments. That requires companies to make an estimate of the amount of interest and principal payments they won't receive in the future. Companies account for that estimate by recognizing a credit loss in the income statement and reducing the carrying value of the held-to-maturity investment with an allowance for credit losses, just like they recognize bad debt expense and an allowance for uncollectible accounts for accounts receivable. Held-to-maturity securities appear in the financial statements as follows. Income statement and statement of comprehensive income. Realized gains and losses are shown in the income statement in net income for the period in which the securities are sold. Unrealized gains and losses are disclosed in the notes to the financial statement. Investments in held-to-maturity securities do not affect other comprehensive income. Balance sheet. Investments in held-to-maturity securities are reported at amortized cost, less any allowance for credit losses. Fair values of those investments are disclosed in the notes to the financial statements. Cash flow statement. Cash flows from buying and selling held-to-maturity securities are typically classified as investing activities. Here's another concept check problem for you. On July 1st, 2021, Williams issued $600,000 of 10% bonds dated at July 1st. Interest is payable semi-annually on June 30th and December 31st. The bonds mature in 10 years. The market rate of interest for bonds of similar risk and maturity is 12%. The entire bond issue was purchased by Joe Inc. Joe Inc. properly classified the investment as a held-to-maturity investment. However, due to unforeseen circumstances, the company decided to sell its debt investment for $550,000 on January 1st, 2023, at which time the bonds have an unamortized cost of $580,000. Please pause your video and write the journal entry that Joe would use to record the sale of this bond and select the multiple choice answer. When you finish, please start your video again and check your work. Joe would debit cash for $550,000, debit discount on bond investment $20,000, debit loss on sale of investment $30,000, and credit investment in bonds $600,000. So the correct answer is C. How'd you do? Did you get that one right? Well, that's all for this video. In the next video, we'll discuss trading securities.